Okay, hi everyone. Welcome to another episode of the Daily Currency Call. So today is Tuesday. Okay, so we'll be going through fundamentals that are related to euro and of course trade ideas on euro, euro pound, euro dollar, and what's that again? DXY as well as usual. Okay, so before I get started, where is my screen? Wait, what happened to my? Give me a moment. All windows. Oops. Where is my? Second. What happened to my? Okay. So, just a disclaimer. Any information shared in this video is not intended to be a trade recommendation. It is solely the opinion and views of the speakers. So please remember to do your own analysis prior to entering any trades. Okay, boring stuff aside. So today, the fundamentals pertaining to euro that I'll be going through is the ECB, well, what happened during the ECB last Thursday. Okay, so actually we received quite a, I would say, hawkish tone, okay, coming in from the European Central Bank. All right, so what you're looking at right now is the European Central Bank's monetary policy statement. Okay, so well, the first paragraph over here actually highlights the the ECB's concern of the Russia-Ukraine war. Okay, let me see, where is the, all these are just the information. Yeah, okay, so it's watershed for Europe. The governing council expresses its full support to the people of Ukraine. It will ensure smooth liquidity conditions and things like that. That is not what I want to talk about. All right, okay, never mind, it's okay. I think later on in the statement, they will actually highlight more on the concern of this whole ongoing war. Okay, but let's get on to the most interesting part first. All right, so basically ECB held interest rate unchanged. Okay, pretty much expected. All right, and the hawkish part is this. Okay, APP. Now, if you guys remember during the previous meeting, okay, the European Central Bank actually highlighted that the bonds buying under PEPP, okay, the Pandemic Emergency Purchase Program, will end, okay, in March, this month, okay, probably by the end of this month, all right, and then after that, in from April onwards, okay, the second quarter onwards, bonds buying under APP, okay, which is the SS Purchase Program, will be increased from 20 to 40 for the second quarter of 2022, okay, and then from 40, it will be reduced down to 30 for the third quarter, and then from the fourth quarter onwards, it will be reduced further down back to 20, okay, 20 billion euros per month, okay. That has changed, okay. So the whole point of increasing from 20 to 40, okay, from the second quarter onwards is to actually facilitate the whole ending of bonds buying under PEPP. Okay, basically is to prevent any knee-jerk reaction from happening. All right, hence the increase from 20 to 40. Right, but this time around, okay, I can tell you, due to well, strong economic recovery in the eurozone. Well, I wouldn't say strong, okay, it has kind of like stagnated already, okay, but the real strong one is the inflation in the eurozone area, okay, has literally, I would say, convinced the ECB, okay, that inflation is likely going to maintain at a high level, okay. More on that later on, okay. But first of all, APP. So over here, based on its updated assessment and taking into account the uncertain environment, the Governing Council today revised the purchase schedule for its APP for the coming months. Okay, previously Q2, they're going to be purchasing 40. Okay, that means for April, May, June, it'll be 40, right? But right now, they have since revised to this. Monthly net purchases under the APP will amount to 40 billion euros in April, 30 billion in May, and 20 billion euros in June. Okay, so instead of a 3 months of 40, right now it's first month 40, second month 30, and the third month 20. Okay, the calibration of net net purchases for the third quarter will be data dependent and reflect its evolving assessment of the outlook. If the incoming data support the expectation that the medium-term inflation outlook will not weaken even after the end of its net assets purchases, the Governing Council will conclude net purchases under the APP in the third quarter. What this sentence over here means is from third quarter onwards, if let's say the outlook looks good, inflation, is more convincing when it comes to maintaining at the 2%, the ECB's 2% targets, then bonds buying under APP will end, will cease, they will put an end to this whole bond buying all in all, PPP will be ending this month, bond buying under PP will be ending this month. APP may actually end in the third quarter of 2022, and you guys know what comes next, what's likely going to come next if APP bonds buying under APP will end in third quarter is interest rate hike. So let's not get too excited over that yet. All right, over here, continue on. If the medium-term inflation outlook changes and if financing conditions become inconsistent with further progress towards the 2% targets, meaning if let's say inflation starts to stagnate from now on and then maybe starts declining and it may actually get lower than the 2% target, then the Governing Council stands ready to revise its schedule for net assets purchases in terms of size and or duration. So in June, the amount that will be purchased is 20 billion euro. And then from there on, if they were to evaluate the situation not to be as favorable, for an end of bond buying, then they may actually consider revising from 20 up to 30 or 40 and things like that. That's what this highlighted line over here is trying to say. So it's still subjected to further revision. Of course, it depends on how inflation turns out to be, right? Over here it says become inconsistent with further progress towards the 2% targets. If it's inconsistent, if it's still up and down and things like that, then of course the Governing Council will actually revise the whole bonds buying from 20 probably upwards to 30 or 40 and things like that. But this change alone, this definite change for sure, the second quarter of 2022 we will be seeing 40, 30 and 20, no longer 40, 40, 40. This change alone was very, very, very actually strong for the euro. In fact, euro actually strengthened across the board for the first at least before Lagarde's press conference started, at least for the 15 or 30 minutes before the press conference started. So this is actually very positive because with this, now remember last year Christine Lagarde has been highlighting over and over again that interest rate hike in 2022 is pretty much not going to be happening. You guys can just forget about it. And then during the previous meeting, Lagarde did not directly turn down the idea of an interest rate hike in 2022. That was last meeting. And then right now, speeding up the whole carrying forward the whole timeline for an end of bond buying under APP is pretty much a subtle hint. I would say it's obvious to some, but it's kind of a subtle hint of saying that, an interest rate hike is back on the table. An interest rate hike in 2022 is back on the table, which is why we see a strengthening of the euro. All right, let's see. Of course, any adjustments? Let me go on in here. So in terms of reinvestments, the Governing Council intends to continue reinvesting, in full the principal payments from maturing securities purchased under APP for an extended period of time, past the date when it starts raising the key interest rate. So what this means is, once this whole APP bond buying under APP were to end, then the next move will likely be an interest rate hike. And once interest rate hike, these whole reinvestments of bonds will still continue. okay, at least past the period whereby interest rates hike. And then from there on, they will actually reevaluate again to see if the Eurozone market requires any more support from the central bank. If no more, or maybe, if they deem necessary to remove any form of bond support, bond buying support, and things like that, okay, then they will start to not reinvest, okay, meaning any bonds that matures, they will just leave it as it is, and then it's a subsequent move of reducing the amount of bonds held by the central bank, okay. Of course, this depends on the economic situation at that time. All right, so key ECB interest rates held unchanged, 0.25, negative 0.5 respectively. Okay, any adjustments, okay, this is another key point. Any adjustments to the key ECB interest rates will take place sometime after the end of Governing Council's net purchases under APP and will be gradual. Okay, so right now, the earliest, okay, based on the most recent meeting, the earliest date for bonds buying to end, okay, is the third quarter of 2022. Okay, so that means we actually have like 2 quarters, the third and the fourth quarter, for this whole some time, okay, this some time over here to take place before an interest rate hike can be seen from the ECB. Okay, in fact, okay, the market right now is actually pricing in 2 interest rates hike from the ECB, okay, totaling 0.5%, okay, so 0.25% each. All right, and with that, we will not be seeing this negative 0.5% anymore. Okay, this is a negative 0.5% actually refers to the amount of money paid, okay, the amount of interest paid by the ECB to the other banks, okay, to the banks for depositing money with the central bank. Okay, so a negative 0.5% would mean that those banks, European banks, okay, who deposit money with the European Central Bank, okay, will have to pay the central bank a 0.5% interest. Okay, the reason why is because the central bank is actually encouraging the other banks, the commercial banks, to actually lend out money to the public and not keeping it with the central bank. Okay, so if they would like to keep money with central bank, would like to save with central bank, they will be charged a 0.5% interest. Okay, so if let's say a 0.5% rate hike were to take place this year, then this value over here will be 0. Okay, meaning that this actually indirectly implies that the market situation is improving. Okay, and hence some leeway will be given to the commercial banks, okay, in terms of them wanting to save money with the central bank, okay, at a 0% interest rate, okay, meaning they will not have to pay the central bank, or they will not be receiving any interest, okay, from the central bank for saving money with them. Okay, so that's what it means. So all in all, this actually, from a negative 0.5% to a 0% would actually mean that that's actually a good improvement in the economy. Okay, let me see if there's any more. Oh, okay, and one more thing, the quarterly economic projection materials was actually being released. Let me see if it's actually been highlighted here, because I have the figures, but I don't think it's going to be highlighted. Yeah, it's not going to be highlighted here. But during the press conference, okay, Christine Lagarde actually mentioned, all right, so inflation projection, okay, for 2022 has been revised from the previous, okay, quarterly economic projection of 3.2% to 5.1%, okay, for 2022. Okay, inflation has been revised upwards. Okay, inflation projection has been revised upwards from 3.2% to 5.1%. That is really a strong, a strong revision. Okay, and then for in the near future, 2023 and 2024, okay, inflation projection has been revised upwards as well. Okay, to 2.1% and 1.9% respectively. Okay, hence we can see that 2022 is 5.1, 2023 is 2.1, 2024 is 1.9. Now, for these 3 years, okay, the figures are actually around, well, I wouldn't say except for 2022, it's not really around the target, okay? But for 2023 and 2024, okay, we can see that the 2.1 and 1.9 figure is actually very close to the central bank's 2% target, okay? And this is what the European Central Bank wants to achieve, okay? Inflation at around its 2% target for a period of time, okay? Basically, not just for 1 or 2 months and things like that, but for a period of time. And 2 years, 2023 and 2024, in this case, would actually fulfill the central bank's condition, okay? And remember, okay, when the central bank, when the ECB actually modified its what do you call that, inflation policy back in, I think 2021 or 2020, okay, I think it was 2021, early 2021, early last year, okay, they actually mentioned that, you know, this is actually one of the criteria for the central bank to hike interest rates, okay. They want to see that inflation, they want to be convinced, okay, that inflation in the horizon, okay, aka in this case up to 2024, okay, they want to see inflation in this horizon to be around the 2% target before they feel convinced to hike interest rates, okay. And right now, okay, we can see that, you know, the projection is actually very close. I would say it's just plus minus 0.1% away from the central bank's target, okay. This will definitely be a convincing point for the central bank to hike interest rates, okay. And then, of course, you know, we can see that all the moves being carried out, you know, all the projections and things like that are actually leading towards a rate hike, okay. The increase in the tapering rate of bond buying under APP, okay, that's one thing, okay. Hence, we can potentially see an end of bond buying in third quarter, okay. And then the revision of inflation projections, okay, in the near-term horizon, okay, which turns out to be very close to be ranging around the 2% target. Okay, that's another point. Okay, with all these two conditions being met, okay, we can really expect ECB to hike interest rate this year. Okay, at least once. Well, this is based on the March what do you call that? March forecast and March you know, decision and forward guidance. Okay, of course things can anything can happen. All right, things can turn around during the third quarter onwards. Okay, which is why the ECB you know, they decide to just leave the third quarter and fourth quarter what do you call that, bond buying rates subject to change, leave it to subject to change. Okay, it's subjectable to any potential revision and things like that. All right, and yeah, overall this is actually a very I would say hawkish ECB. In fact, I think the market wasn't expecting this to happen. Okay, wasn't expecting the ECB to revise its second quarter's bond buying rate. Okay, they are actually hoping that the ECB will you know, revise its third quarter. Okay, third quarter is actually the from I think 40, 30, 20. Yeah, third quarter is they are supposed to be purchasing 30 billion euros worth of bonds on a monthly basis. Okay, so the market was actually expecting them to revise it down 30 to something lower, some figures as lower. Okay, but they did not expect the second quarter figures to be changed instead. Okay, which is definitely more hawkish. So right now we can see that the central bank is actually trying to you know, create this whole flexibility. We would like to have the option to choose when to increase interest rate, possibly at an earlier timeline, okay, as opposed to, you know, ending QE, ending bond purchases under this APP by the end of this year, and then, you know, hence most likely pushing interest rate to next year and things like that. You know, right now they just want everything to have, they just want to have full control over it. Okay, and you know, the whole uncertainty, of course, you guys already know, okay, is due to the ongoing war between Russia and Ukraine. Okay, if that situation were to, you know, de-escalate and, you know, improve and things like that, then, you know, we are more confident that the European Central Bank will likely be ending bond buying in the third quarter, and we can actually you know, start expecting probably a couple of interest rate hike from the central bank. Okay, so overall very hawkish tone from the ECB. And if you guys actually traded the ECB last Thursday, okay, you guys will realize that yes, there's a strengthening in the euro across the board for the first well, within 1 hour, I would say. But then afterwards, it actually weakened more than it actually strengthened. Very ironic. Okay, very ironic. My take of why this happened, okay, was this. All right. Remember that the US CPI data was actually being released at the same time when Christine Lagarde, the president of ECB, started her press conference. Okay, and the inflation data, okay, although it's as expected, all right, I think it was a headline inflation was around 7.9%. Okay, is a crazy high number. Okay, like I think last week, or yeah, I think it was last week when I actually talked a bit about this whole inflation thing, saying that no, sorry, it was during Powell's press conference. Okay, when I was actually mentioning that strong US employment data were to give, were to be more convincing for the Federal Reserve to hike a 0.5% rate. I also mentioned that 7 days later, okay, when the inflation data were to be released, if it's close to 8% or even exceeding 8%, okay, annually, okay, inflation would exceed 8%, then that will really, create a very, I would say, headache situation for Jerome Powell specifically, okay, but for the Federal Reserve as a whole, as to whether they should be carrying out a 0.5% rate hike or a 0.25% rate hike, okay? But I think they'll be meeting this week, okay? But I will be sharing about this whole Federal Reserve thing tomorrow, okay? So just remember to join the call tomorrow, and I'll share more about it, okay? And we'll talk more about it tomorrow, all right? So because of this whole, strong inflation figure and things like that, some actually speculated that this ECB move was actually priced in, although I personally don't feel that is the case, okay, because it's really a very surprise it's a very strong surprise that actually, caught the market unprepared, I would say, all right. Yeah, that led to the eventual weakening of the euro against the dollar subsequently and things like that, okay. But my take is basically the ongoing war, okay, that's one thing, and the strong US CPI data, okay. So overall, nonetheless, we can still expect the ECB to hike rates this year at least once, okay, based on the March meeting, okay. So any questions on the European Central Bank's this whole hawkish tone sent out? Okay, if there's no question, all right, I will hand it over to Jin for his analysis on the DXY, and followed by his trade ideas on Euro dollar and Euro pound. Over to you, Jin.
Thanks for that, Kim Hong. So a lot of details there on the ECB decision last week and what happened. Just quickly sharing with you here is that on the charts, what actually happened on the charts here for the euro was that news when it got released, we saw that big move towards the upside. But as we were talking about it last week already, we were looking for it to reject that resistance level of 1.1072 before selling it back down. So that actually worked out quite nicely because we had that view of the US CPI number taking a little bit more impact on the overall move, together with the uncertainty that's happening in the Eurozone. So what's happening now is that we're seeing the euro dollar sitting at this 1.0972 support level. What could happen at this point? First, we will look at the dollar index. Right, looking at the dollar index, it has reacted over the last couple of days or even into last week. We saw it climb very significantly towards that 99.50 level, resisted once, came back down. Over the last couple of days, yesterday came very close towards that 99.25 level, and now retrace, looking like a consolidation, possibly even a further retrace back down. I think we could see the dollar index come as low as that 98.45 level. I think we could see that retrace back down towards that point, or even maybe slightly lower before we see another upside move towards that 99.50 or even that 100 level. possibly going to happen on Thursday together with the FOMC release on the rates decision. Looks like it's going to be a 0.25% rate increase for the FOMC, for the US from the FOMC. So looking at that retrace in the short term before that bounce up as we look into later into the week back towards that 99.50 and possibly even higher. So what to expect here with that retrace coming back to the euro dollar again is that I think we might see the euro dollar move up from this support of 1.0952 towards that 1.1072 resistance level. I'm not sure whether it will move all the way up. Quite a significant move there. If it were to move up, that would be about a 85 pip move towards the upside. I think that we're not likely to see such a big move up. I think we're likely to see it come towards that 1.1 level, consolidate, and maybe turn back down again. So two ways to look at the euro dollar at this point is if it does go all the way towards the upside, then we're looking for that repeat of what happened last week. Look for that selling opportunity again below 1.107. We're looking at selling opportunities at about 1.1059 or 1.106. You have that's a bit too big. About 40 pip stop loss for a 100 pip take profit level. You're looking at a 1:2.5 risk reward ratio towards the downside for the euro dollar on the H4 time frame. But this means that you have to sit there, wait for it to track towards the upside, resist that level, turn back down before looking to sell. A lot of waiting for that trade opportunity. Alternatively is that it could move up a little bit more, sit across and turn back down. I would still advise to look for that selling opportunity at below that 1.0943 level. Again, stop loss could be kept quite tight at about 40 pips. Take profit would be a little bit more conservative at about 80, the previous low point there. So you're looking at a 1:2 risk reward ratio towards the downside if it breaks that support level of 1.0945. So selling opportunity at about 1.0925 level. So nothing pressing, nothing immediate to do for the euro dollar at this point, because we're either waiting for it to move up slightly, consolidate, turn down, break the support, or to move up significantly, get resisted, turn down, and then look for that selling opportunity. Two trades there, but a lot of waiting for the euro dollar at this point. What you could be looking for is on the euro pound, right? With the euro dollar likely to move towards the upside, towards that resistance level, I'll be a bit more confident on the euro pound because we've seen it climbing since the 7th of March. Significant move towards the upside, consolidating at this 84 level, now looking to move higher. What you could be looking for here, because of the euro dollar moving up, could be dragging the euro pound higher. You could be looking at a managed trade where you're looking to buy it up towards that resistance level of 84.67. A tight take profit about 30 pips. Stop loss should be quite tight at about 30 as well. Slightly over a 1:1 risk reward ratio towards the upside. But this will be a trade that you want to manage quite closely. Your buying opportunity at about 84, above 84.30 towards that 84.67 resistance level, something that you could be looking at if we do see the euro dollar continue to push higher, or rather trade the euro pound rather than the euro dollar towards the upside, following that short-term trend, following that move we've seen on the euro pound. With that said about the euro pound and the euro dollar and the dollar index as well, I hope you caught the Aussie trade that we were just talking about yesterday as it broke that 72.46 level. It came all the way down, hit that take profit, and then now it's sitting right there. Be very careful if you haven't entered that trade, not worth trying to trade it down to that support again. I think we're going to see a similar reaction at this point. We saw it hit, bounce back up. We might see that bounce back up again. So too late on the Aussie dollar. Time to change a bit of focus towards the euro, waiting for that, or the euro pound, or maybe even the pound dollar, with quite a few news coming out for the pound dollar, but we'll tell you more about that tomorrow as we go through the pound dollar. So with all that said, I hope you've gone through this session and you've taken some notes. No trade on the euro dollar at this point, nothing to do, wait for it. Possible something to do on the euro pound. I hope you had a good session. Trade well, trade safe. We'll catch you tomorrow. Take care now. Bye-bye.